This is the Chappell Real Estate Show, episode number 30.
Welcome to the Chappell Real Estate Show, your source for the latest real estate information so you can buy, sell, and invest with the best in Texas. Whether you're a first-time buyer, a current homeowner, or a seasoned investor, you've come to the right place. We're here to simplify all things real estate so you can achieve your goals of property ownership with your hosts, Daniel and Roger Chappell.
What's up, listeners, and thank you guys for tuning into the Chappell Real Estate Show, your source for the latest real estate information so that you can learn how to buy, sell, and invest with the best. I'm your host, Daniel Chappell, and I've got my co-host here with us, Roger Chappell. How are you doing, Dad?
I'm great. How's everybody doing today?
Oh, it's another day in paradise. So today we are going to be talking about credit scores. So it's kind of come to our attention, and we have these kinds of conversations with our clients every day, but credit is one of those things that seems to be a bit of a mystery for a lot of people, where they don't really understand what factors play into the credit score. How do you improve your credit score? How long do things stay on your credit score if you have any delinquencies and things like that? So today we're going to cover all of those questions for you guys. So super excited to bring all that to you guys today. But first, Dad, what is today's Chappell Chunk for our listeners?
So today's Chappell Chunk is simply pay attention to your credit score. There are all kinds of apps out there nowadays where you can go in and take a look at your score. Now, keep in mind, these apps are not 100% accurate. In fact, I'd feel safe in saying they're probably around 70 or 80% accurate. The good thing behind that is that it at least allows you to be able to see when certain things pop up on your credit that maybe shouldn't be there. For example, if a new credit card gets opened or something along those lines and you didn't do it, then you might be able to spot that pretty quickly. It's one of the many ways that you can do to kind of monitor your own credit. Because in today's digital world where our identity is being stolen all the time, that is extremely important. So that's today's Chappell Chunk. In order to enhance your credit scores, keep an eye on your credit and make sure that you take action when necessary.
Absolutely. And, like he mentioned, there's a lot of different apps out there. I know with Chase and Capital One, or if you have one of these big banks, they usually will have some kind of source that will be able to provide you with, like he said, a somewhat accurate credit score. It will show you any activity on your credit report. And even better, you can actually set it up to send you notifications so that if you're out and about and you get a notification that somebody's spending your money out in another state, well, you can just about guarantee that that's probably not you. So it's always great to have that stuff available to you. Credit Karma is another really good one to use. So check out those resources. They're definitely helpful. All right, so let's go ahead and get started with just the basics of credit. So what is credit? Dad, can you shed a little bit of light on what is credit and who are the credit reporting agencies that determine credit scores?
Yeah, so credit literally is nothing more than a method to measure one's worthiness, if you will, to purchase items of value. And that can be any number of things, from your ability to get a credit card approved, to purchase a vehicle with credit, to get a line of credit from any financial institution, or in our case, as many of our people are purchasing homes through a mortgage. So the credit is just one method of purchasing goods or services. Now, the three major credit reporting agencies are TransUnion, Experian, and Equifax. With those three reporting agencies, basically most lenders, depending on what it is that you're applying for, will use one of those three or a combination of those three reporting agencies to determine what your true credit score is.
Yeah, and what does that credit score range from?
So the low range is 300. The high range is 850. That is a very large range. Your credit score can determine what your interest rate can be on a mortgage or on credit cards and things of that nature. In some instances, your credit score can also determine whether or not you qualify for a particular job. For example, for folks that are in the military and you're trying to get a top secret clearance, or any job, a government job where you're trying to get a top secret clearance, your credit score and your credit rating is extremely important. And there's a number of reasons why, and I won't go into those, But the bottom line is your credit score is more important than you can imagine.
Yeah, absolutely. And we deal with credit scores every day with our clients as well. So as he mentioned, there's a pretty wide range from 300 all the way up to 850. But I know the real question is, what does your credit score need to be in order for you to be considered a pretty good credit worthy candidate? And in general, somewhere around the 620 plus range is that's kind of the base number. You want to be at least at 620. Most federal loan programs in terms of homes are going to require 620 or above. I know when you're around that credit score, you can probably get qualified for some various credit cards, but they're going to be usually credit cards that have annual fees. They're going to be credit cards that are going to have higher interest rates. So the higher your credit score is, the better credit accounts that you're going to qualify for, the better scores, as my dad, or rather, the better rates that you're going to qualify for, as my dad previously mentioned. So that's kind of the ballpark. You want to be around 600 plus, and that's a good range. If you're above 700, that's excellent, and then above 800, I mean, you're exactly where you want to be. So now let's talk about some of the factors that actually play into your credit score. So, Dad, what are some of the things that that people need to be keeping an eye on that play a factor or a large factor into what the actual credit score is?
That's a really good question. So typically when we're talking with a lot of our potential buyers, they always ask us, well, I don't want to apply with too many lenders because it'll impact my credit score. Well, in reality, it has the number of lenders that check your credit has a very low impact on what your credit score is. It does have a negative impact, but it's so low that it's so minuscule that it's not worth worrying about. The things that are worth worrying about are, number one, and I would say probably the most important, is your payment history. So that counts towards 40% of your credit score. So what that entails is making sure that you've paid on time, you don't have any true collection debts and things of that nature. You've actually kept up with your credit. Payment history is the biggest one. It's not the only one, but it is the biggest. Second behind that would be the age of your credit history.
So the age of credit history is actually an average of all of your accounts. So I know for my age of credit history, it's somewhere an average around 8 or 9 years. And a big reason for that, and we'll kind of touch on when we talk about some of the strategies to improve your credit later on, but my parents actually put me as authorized users on their credit accounts when I think I was maybe 14 years old. And in doing that, I essentially inherited their good credit. So when I turned 18 and was actually able to apply for my own credit cards, apply for loans and things of that nature, I was already at a 700 plus credit score and was just able to compound and build on that. So that's another really, really good strategy to use, is being, used as an authorized user, because that, like my dad mentioned, a very high percentage of your credit score is composed of the age of your credit history. So the longer that average age is, the better off you are, which is another reason why, and we'll talk about this later, you don't want to open up too many new credit accounts too often, because that's going to shorten your average age history.
So it's interesting that you mentioned that. So my average age on my credit history is 6 to 7 years. Yours is older than mine. But here's what has affected mine negatively in that aspect. So I have borrowed on numerous mortgages over the years, and then we pay them off or we refinance. And every time we do that, it's the credit history on those particular loans is very small, 2, 3, 4 years. Because as you know, Daniel, your mom and I have utilized a number of strategies to allow us to collect our wealth the way that we have over the years. And a lot of that involves refinancing and things of that nature. So by doing that, it has negatively impacted our credit score by the age of the credit. So it doesn't necessarily count one of my credit cards that I know is over 20 years old. It counts, but what has impacted it more negatively than anything is the mortgages that we have that are only 2 years old or maybe less than that.
Yeah, and that kind of brings up an interesting point, because age of credit history I mean, that's what, and I feel like this is one of those things that makes credit such a mystery to people, is that nobody can really tell you exactly, okay, if you do this, this is what's going to happen to your credit score. And you know, those kind of specifics truthfully don't really exist in the credit reporting world. So it's interesting that you mentioned, okay, you know, you were borrowing against, you know, these assets that you have, and you're paying them off very quickly. I wonder if that wouldn't improve your credit worthiness. And technically speaking, yes, it would shorten your credit length. But I mean, if I'm a creditor and I see that this person is borrowing this amount of money and paying it off very quickly, I'm probably going to think that they're a pretty worthy applicant to lend money to. Wouldn't you think?
Yeah. So what happens in these things is, remember, your FICO score is basically computer generated. They don't get a chance to talk to you as a borrower. So that literally is just computer generated. So the stats that we're giving you and the numbers that we're giving you are basically from an algorithm that says, okay, this is how much weight we're going to give each aspect of a person's credit score. So with that said, that's where the negative impact comes in.
No, that makes sense. Okay, so continuing on, so 40% of your credit history is comprised of your payment history. 21% roughly is the age of credit. So what else plays a factor into the credit score?
Your credit usage and percentage. Now, I'm not real sure exactly what that means, other than the credit usage, I'm going to assume, is if I have a credit card that has a maximum limit of $2,000, and then I use consistently $500 or less, and I pay that down every month, then I still have basically an average of, say, $1,500 that I can use as usable credit. I'm assuming that's what this means. Do you know anything different on that, Daniel?
Yeah, so the percentage of credit usage is essentially the amount that you have in balances. So in your example, you know, if you have a credit card that has a $5,000 balance, you use 500 of it, but you pay that statement balance off every month, you're not actually carrying a balance on that card. There's a zero balance on that card in terms of credit reporting, right? So if now, let's say, for example, I have a credit card that offered me interest refinancing for a year, so I financed my new $2,000 TV. And that $2,000 is, I have a year to pay it off before the interest starts accruing, but over that 2-year period, there's still going to be a balance on that account until I pay it off. So that is what that percentage is. So it takes all of your credit accounts that you have, it adds them all together. So your total credit, the amount that you have in usable credit versus the amount that you actually have in balances. So, and typically you want to keep that below 30%. So to keep numbers simple, if you have $10,000 worth of credit usable, you don't want to exceed 3,000 as your rolling over balance. And that will typically be a good place to keep your credit, keep it higher. Typically below 10% is even better. And then if you can keep it at zero, that's a phenomenal thing as well.
Yeah, so one of the strategies that I suggest people use is, you mentioned statement balance on your credit card. So I haven't paid interest, your mom and I haven't paid interest on a credit card in years and years and years. And the reason being is that we do pay the statement balance, but we don't pay the entire credit card balance. So a portion of that is carried over to the next month. So what happens is, on your credit card, there'll be a date, a cutoff date. So whatever that cutoff date is, I'm going to use the date of the 20th of the month. Whatever month that is, it doesn't matter. So on the 20th is where the cutoff is. So I pay the balance of my credit card up to the 20th, but I'm still borrowing money or using that credit card, and it gets carried over to the 21st and beyond. Okay, so that portion of the balance gets carried over, but I'm not having to pay interest on it because it came after the 20th. Does that make sense? So basically, I'm carrying a balance on each and every month, so that adds towards, or goes towards my credit score as positive. Even though I'm not paying interest on it, I'm still carrying a balance on that credit card itself.
Yeah. The other three things that actually play into your credit score are going to be the number of inquiries you have on your account, the total balance of all of your accounts and then the actual available credit that remains after they've calculated your total balances. And those carry a less weight than the other categories, 11%, 5%, 3%. They're relatively low. So they don't play a huge factor. And this kind of ties into something that my dad said earlier, is that the inquiries on your account, they actually don't play a huge role in your credit score. They do play a role, and it's definitely something to consider. If somebody does a credit check on, if you're buying a new car, and then cars are the worst usually because they're going to run your credit multiple times with multiple different banks trying to get you the best rate. So those kinds of things, they do impact your score, but we're talking a couple of points. It's not going to be something detrimental where your score drops 30, 40 points because you hit a new inquiry. Usually it's just going to be a couple to a few points, but it does play a factor in that credit score.
That's correct.
Okay, so now that we've covered all of the things that go into your credit score, let's talk about why is your credit so important. So, Dad, why don't you kick that one off for us?
Yeah, so I mentioned this earlier about jobs. So what a lot of people don't realize is that when one is applying for a job, one of the ways that a person can show their credit, their worthiness, is to have good credit. What that means is you've shown some financial stability, and by doing that, it shows responsibility. And a lot of employees are looking for people who are responsible. So by keeping your credit score up shows that you really do care about yourself and about where you're going in life. And that speaks volumes for a lot of managers and management positions especially. I mean, if you're applying for you're a high school student, or you're just getting ready to go into college and you're applying for a job at, say, a bookstore or a convenience store or something along those lines, the credit score is obviously not going to play that big of a factor in it. But when you start going into management, that is definitely going to be one of the things that they look at. It also allows you to borrow money. So what that means is simply when you have really good credit and you go to the bank and you want to get a car loan, if you have good credit, you'll be able to get that car loan. If you don't have good credit, you might be able to get a car loan, but the interest rate is going to be dramatically higher. And what a lot of people don't understand about interest rates and why that is so important is that it really does have a major factor on your payments. So, I can bring up a really good example. I have a client that I'm working with currently, and we keep running numbers on various investment properties. And one of the things that we've noticed is that on investment properties, the interest rate is a little bit higher than it is on a primary home. So if it's your primary home and it's not an investment property, you're going to get a lower interest rate. Well, that interest rate may only be 1%, a 5% versus a 4%, or maybe even 2% versus a 3%. With 1% as a difference in payment, I have seen a dramatic difference in what that actual payment is going to be. So if you can get a lower interest rate, you can afford to buy a much better house, if that makes any sense at all, because your payment is going to be dramatically lower on a lower interest payment, on a lower interest rate. And that a lot of that is directly connected and related to your credit score.
Yeah, absolutely. And to your point about the jobs, yeah, for both of the management positions that I have ever worked in, I had to have my credit checked prior to being able to move up into those positions. And it makes perfect sense because as a leader, especially in the industries that I was in the restaurant industry and then in the sales industry, you're managing P&Ls, profit and loss statements. So if you can't handle your own P&L, your own financial stability, how can you be expected to, help manage somebody else's, and especially in a business where that is what makes them their money. So, it's definitely something that it plays a big factor in showing your ability to manage your own finances and show your responsibility. So it's definitely extremely important.
You're exactly right. You're spot on with that.
Another thing that I want to touch on as far as the ability to borrow money is kind of today's current rate of inflation. So something that I've been kind of talking to a lot of our clients about has been, we know that inflation is on the rise and interest rates are still extremely low. So a great hedge against inflation is if you have cash in the bank right now, it's depreciating. If you can get it into an asset and use the cash that you have, use your good credit to leverage it to borrow more money so that you can then, instead of holding cash in an account that's depreciating, put it into a high value appreciating asset. That's phenomenal. I mean, it's a great way to put your money at work. It's a great way to take advantage of today's low rates, because in 10 years, we don't know where the economy is going to be. Rates could be substantially higher, they could be lower, but the dollar could be worth 10 to 20% less. So a lot can happen in that amount of time, but the value of real estate, as we've seen, is only being valued more. So to me, that's one of the biggest things, is take advantage of your credit score if you have a good credit score. If you don't, focus on improving your credit score so that you can take advantage of that key point, and it's leverage. Using your great credit score and your cash on hand to leverage yourself to be able to earn more money. If you use credit correctly, it will make you money.
That's correct. So Daniel, you touched on this earlier, so I wanted to ask you about this. When do you think a person should start building their credit?
Immediately, today. If you haven't started building it, now. And the reason I say that, as I mentioned before, I was fortunate enough to be put onto my parents' accounts early on. I was 13 or 14 years old when I was added as authorized users to their credit accounts. So I was able to inherit a good credit score at the age of 18. That's a beautiful thing. And I didn't even realize how awesome that was until in recent years. I mean, when I really started to understand the impact that credit has on your ability to borrow, once I actually started getting into real estate and owning a home and those kinds of things, I started to realize how important, how crucial those elements are. But yeah, so I mean, immediately is the time to start building your credit. And it doesn't matter if you're 15 years old or 50 years old. If you are under the age of 18, or if you have kids under the age of 18 and you have good credit, add them as an authorized user to your accounts. Give them some rules. I'm not saying give them a credit card and let them go spend all the money they want, but give them that sense of responsibility. Let them understand what it means to have a credit card. Have them pay you at the end of every month. And if they don't have enough money to pay you, charge them the interest. Take the credit card away. Make sure they're not making purchases that they can't afford. Teach them these things before they're out of the house, because I promise you, the real world will teach them. And it's not a lot of fun to learn the hard way.
That's right.
All right. So with all that stuff being said, now let's kind of talk about what are some of the strategies that you can use to improve your credit score. Dad, let's get into it.
Yeah, so we've got quite a bit here that I think is extremely important. So if you haven't paid attention until now's the time to pay attention, because we've got some really great information for you. First of all, you have to check your credit report for errors. You'd be surprised how many things will pop up on your credit that have errors. So I'll give a little history on my situation. So I was married once back in the 80s, and I got divorced. And fast forward several years, like maybe 5 or 6 years later, your mom and I are going to buy our first house. And when we go to apply, we get our credit report back. And then I found that I had a number of negative things on my credit report, such as a car had been repossessed, and there had been 2 or 3 other credit card accounts that had gone into default and into collection. Well, obviously, that is not good. If I'm trying to buy a house and I've got that kind of stuff staring me in the face, we need to get that squared away. Fortunately for me, I had a divorce decree that granted all of those debts to my ex-spouse and not to me. I did not inherit those debts. Those went to her. So with that, I was able to prove that those were not my debts, and I submitted that to the credit reporting agencies, and they did remove those negative remarks from my credit score. From a credit report. Now, mind you, that was back before they had the credit reporting the way they do today, but the principle is still the same. If there are errors, you reach out to the credit reporting agencies, point out those errors, and then show your proof that those are errors, and they will take care of that for you. They should. It shouldn't be that big of a problem. But my point behind all of that is that a divorce can have some negative impact on your credit. It just does. So when people get divorced, sometimes you inherit half of the debt and the other spouse inherits the other half. So you kind of got to work through all of that. And if something happens with the other spouse and you're on that debt, then it could have a negative impact. So just keep that in mind and be aware that could happen. But there's ways to get that fixed.
Yeah, no, that's a good one. Okay, so number 2 is going to be to pay your bills on time. So as we mentioned, one of the largest or the largest impact on your credit score is going to be your payment history. So you want to make sure that you're making your payments on time. If you miss a payment, it's actually not going to be reported to the credit agency immediately. So if you're only a day or two past due, call the company or the account holder, or rather the lender who holds your account, and find out if they can, remove the late payment, not report the late payment, if they can give you back the money for the late fee. All of these things, your credit reporting agencies are going, or not the agencies, your credit accounts are going to want to help you out in terms of making sure they get their money. They want to get paid. So work with them and reach out to them. If you're not notorious for these kinds of mistakes, just about every account that I've ever had will credit me back a late fee at least once a year if it's not a very common occurrence. So, it's a great thing. Be sure to contact them, but make sure you keep on top of your payments. Now, if you do have some late payments that actually get reported to the credit agency, it's going to take some time to get those payments removed. So usually the way that the payment history is calculated is, of all of your payments, you want to have 97% or more on-time payments. If you're below 97%, it's going to impact your credit score, and you're going to have to slowly bring that average up by consistently not missing your payments. And that credit history goes back 7 years. So it's going to take some time. If you have missed payments from 5 years ago that are holding your average below 97%, it's going to take some time for that to build back up. And it's okay. It's going to take time. But that's the thing, is it's one step at a time, one day at a time, and you'll be able to get through it. So, Dad, number 3?
Yeah, and if here's an important one. If you're behind, then get caught up. It sounds so easy to say, but it's a fact. If you're behind in your payments, you need to pay a little bit extra every single month until you get caught up. And if you can only afford an extra $5, then pay the extra $5. Stop going to Starbucks for a day. Come up with that extra $5. All of that over time adds up, and it does reduce the amount that you owe. So keep that in mind. If you're behind, get caught up.
Absolutely. And actually, there's a great book called The Latte Factor that's all about finding out what your latte factor is. Find out what that one thing that you spend a little bit too much money on. Could be the Starbucks. It could be maybe a pack of cigarettes, or, find out where you can save $5, $10, $15, $20 a week maybe, and put that towards your debts.
Yeah, that's a great point, Daniel.
Another thing that you can do to improve your credit, and this really helps when you talk about your credit utilization. So we mentioned this earlier. If you, of your total credit availability, if you're using more than 30% of your total balances, then that's typically going to hurt your credit a little bit. So the lower you can get that percentage, the better. So a strategy that you can use to get that percentage lower that doesn't cost you any money is actually to call those creditors and ask for a credit balance increase. So if they increase the balance, or rather the available credit on that account, it's going to lower your percentage usage. So that is a great strategy that I was able to use when I was working on building my credit up to buy my house.
Yeah, absolutely. It works. So one of the other things you can do, and I keep talking about this, about paying on time and get caught up if you're behind, et cetera, but pay down your revolving credit accounts. What is a revolving credit account? Well, like a credit card. It's revolving because you have an amount on it, a maximum amount, but you can charge any amount you want up to that amount. That's a revolving account. So if you can pay down those debts, get it down as quick as you can. And that's why over the years, I've never paid interest on a credit card. And the reason being is I use that credit card for every purchase. I don't use cash anymore. That's literally my credit card. So with that, at the end of the month, well, we pay that balance at the end of the month. But it's just like paying cash. Because if I can't afford to do it, I'm not going to put it on the credit card. That means I don't need it. Now, I'll use the credit card because I know I need credit score and credit history. That's the only reason I use it. But it took us years to get to that point. It wasn't like I just started this and boom, there we go. No, it took years for that to happen. But since then, I don't want to go back to that. So it's just not. I don't like paying interest on a credit card. Those interest rates are astronomical. So no, I'm not paying somebody a 19 or 18% interest on a credit card. That's not happening.
Yeah, no, those interest rates really are just crazy how high they are.
Yeah, they'll kill you.
All right, so this is going to seem kind of confusing, but never, ever, ever initiate the closing of a credit account. So if you have, and I've had this happen with a couple of my accounts where I had a Target credit card, I don't know, back in college, and then I just stopped shopping at Target. I don't really go there very often, except for maybe a thing or two. So I just stopped using that credit card and I kept it open, but I never used it. And I think after maybe 3 years of me not using that account, the creditor closed the account. And in the creditor closing the account, it didn't negatively impact my credit. However, if I would have initiated the closing of that account, which I have done for other accounts before, then it will negatively impact your account because you are the one that's actually starting the process. And usually if you're closing an account, it's going to be for one of two reasons. One, the account balance is at zero and you're no longer using the account, in which case, go ahead and leave it and let the creditor close the account. Or number two is you have too high of a balance, you can't afford the interest payment, and you're now settling and coming up with, okay, I'll pay you back this amount of money in turn for you closing the account and, whatever. So those are the really only two scenarios in which you're going to need to have a credit account closed. So don't initiate it. If you don't have to initiate it, then don't, because it will negatively impact your credit if you're the one who starts the process.
Yeah, and finally, here's one that is extremely important. Don't open up new lines of credit unless you absolutely have to, especially when you're looking to buy a house. So let's assume that you've applied for a loan now and you're looking to move forward on buying a house. And then all of a sudden, and I'm telling you, this happens. Once you qualify for buying a home, every creditor and their brother is going to start sending you stuff in the mail. You're going to get emails and you're going to get all of these things about open credit with us. Don't do it. Do not do it. And over time, too, as your credit score improves, you're going to continue to get all of these notifications. We want to loan you money, open up a credit card with us, blah, blah, blah. Do not do that. Manage what you already have open. Don't open up any new lines of credit unless it's absolutely essential that you do so, especially while you're in the process of buying a new home. You just don't want to do that. It's not helpful. It has a much bigger negative consequence to you than anything else. So what will happen is, and one of the most attractive things is that you get these notifications in the mail that says, okay, open up, I'll use a furniture store. Come buy your furniture with us. We'll give you 0% interest for 24 months. Okay, great. That's 2 years, no interest, right? So you're in contract for a house and you go and you purchase all this new stuff. It'll be delivered after you close. Well, here's the problem. Now you've affected what's known as your debt to income ratio because you opened up another line of credit. Whether or not they're charging you interest is beside the point. They opened up a line of credit allowing you to use X amount of credit. Well, that has a negative impact. The other thing to keep in mind too is that let's assume you don't make your payments for the first year or 2 years, and then all of a sudden the note comes due at the end of that 2-year period. All of that interest over the previous 2 years gets accumulated, and now that becomes part of your credit account as well. So you don't want to do that. It's just not a good idea to do. If you do decide to do something like that, and it is essential, make your payments in a timely manner every month. And if you can't, make extra payments to it. There's no harm, no foul in doing that, and it will go towards your principal, which is always a good thing. You also want to make sure that when you're taking out these various loans that there are no penalties for early payment. So in other words, if you open up a line of credit for 48 months or 24 months with no interest and you pay it off in 18 months, you want to make sure that there aren't any penalties for doing so.
Yeah, no, that's definitely a good point. And then I kind of want to give our listeners an example as well, because I know we mentioned, especially when you're under contract for a house, you don't want to open too many new credit accounts. But there are some scenarios in which opening a credit account might be right for you. So I kind of want to present our listeners with a scenario. So let's say, for example, you have a credit card account that you have a $5,000 balance on, and you've been trying with all your might for the last year to get it paid down, and you're just not chipping away at the balance very much at all. So you may be able to get qualified for their credit accounts that will offer you 0% interest for 12 months, 18 months, 24 months on balance transfers. So what that means is that you can take that $5,000 balance from your credit card that has an 18 or 20% interest rate, and you can transfer that balance. There's usually a fee associated with it, maybe 3, 4, 5%, but much lower than the interest rate. So they transfer that balance, they charge you a fee on it, and then that balance is now subject to no interest for whatever that entry term is. So sometimes it's 6, 12, 18, 24 months. It just depends. But that's a great strategy to lower your interest rate, make it to where your payment is actually going towards the entire balance whenever you're making those payments. And that's a really great strategy you can use to try to pay off debt more quickly. So I wanted to give that example to you guys. It's a strategy that I've had to use before in the past, and it was definitely helpful for me at the time. So I want to make sure that all of our listeners know that there are other options out there for you. You just might have to get a little bit creative.
So I want to make sure the listeners understand, too, that we are not financial planners. We're not financial advisors. We're simply relaying to you things that we, Daniel and I both, have learned through our own personal finances over the years, some of the strategies that we have implemented, and then additionally, some of the other things that we've learned by doing this business and learning from other folks what worked for them or not. Does that make sense? I just want to make sure that everybody understands we're not offering financial advice in this particular episode, but we are telling you the strategies that we have implemented that were very helpful and successful.
Yeah, absolutely. Well, thank you for qualifying that for us, Dad. Any other closing thoughts for our listeners today?
Of course. I bet you can't guess what it is.
I don't know. Maybe something to do with referrals?
Referrals. That's it. So as you can tell, Daniel and I have done quite a bit of research on all of our episodes, and we've developed a lot of relationships with a lot of people. So we're happy to refer you folks to the creditors that we know in the credit, I forgot what you call them, the folks who can actually help repair your credit. We have those folks available, those resources available to get you onto them. So if you're having issues and you really need some help with that, let us know. We'll be happy to refer you out. In addition, if you know anybody looking to buy or sell real estate, or you think that this episode is going to be important to somebody else, by all means, please share it, like it, leave us a comment, all that kind of stuff. It really helps us get this out there to more people who could possibly use this information.
Absolutely. Well, thank you, listeners, so much for tuning into the Chappell Real Estate Show. We love spending this time with you every week, and let us know what you want to hear about next. We want to bring some more guests onto the podcast, so if you know somebody who may be a good guest or a good fit for our show, please let us know. We'd love to connect with them and get some people on the show. So thank you guys again for tuning in. This is the Chappell Realty Group signing off. You guys have a great week.
Thank you for joining us this week on the Chappell Real Estate Show. If you enjoyed this episode, share it with a friend and leave us a review. Find us on social media at Chappell Realty Group and online at chappellrealtygroup.com. Until next time.